What actually happens after a $5 billion liquidation wipes through the market in a single wave? History doesn't guess. It answers clearly, and the answer is rarely comforting. Events like this don't come out of nowhere, and they don't end quietly. A liquidation of this size acts like an earthquake, revealing weaknesses that were hidden during calm periods. Prices may stabilize briefly, but the real damage often unfolds afterward when confidence breaks and forced reactions begin. In this video, we're going to walk through what history shows happens next. Not opinions, not hype, but repeatable patterns seen across previous financial shocks. If you've ever wondered why experienced players step away after moments like this, you're about to understand exactly why timing matters more than hope. Massive liquidations are never isolated events. A $5 billion liquidation doesn't end when the numbers stop scrolling on the screen. Historically, it acts as a trigger, not a conclusion. Large liquidations expose leverage that was quietly supporting prices. Once that leverage is flushed out, markets struggle to regain balance. What makes this dangerous is the delay. The initial drop feels contained, but the system has already been weakened. Margin calls continue, positions are quietly closed, and liquidity thins. This is why markets often bleed afterward instead of recovering strongly. History shows that big liquidations start chains of forced selling that can last days or weeks. By the time retail investors realize what's happening, the exit has already narrowed. Liquidity vanishes faster than people expect. After a liquidation of this scale, liquidity dries up in a way that surprises almost everyone. Order books may look healthy, but depth disappears the moment pressure returns. Historically, market makers widen spreads, reduce exposure, or step back entirely. This makes price movements more violent. Even on small volumes, the market becomes fragile. What used to feel stable suddenly moves sharply with minimal activity. This phase is especially dangerous because traders assume conditions are returning to normal. They aren't. Liquidity doesn't come back emotionally. It returns structurally, and that takes time. Many of the worst drops in history happened after investors believed the danger had passed, not during the initial liquidation itself. Confidence breaks before prices. Do markets run on confidence as much as capital? And a $5 billion liquidation damages both. History shows that after major forced selling, participants stop trusting price stability. Even strong rebounds fail to convince experienced players. This hesitation reduces participation, which weakens recoveries. When confidence cracks, every move is questioned. Buyers become cautious, sellers become aggressive, and volatility increases. Prices don't need bad news to fall. Uncertainty is enough. This psychological shift is subtle but powerful. Once traders start doubting the system's resilience, reactions slow and exits speed up. Confidence takes far longer to rebuild than it takes to destroy, and history shows it rarely returns quickly after events of this magnitude. Leverage never fully leaves on the first flush. One of the biggest mistakes people make is assuming a large liquidation clears all the excess leverage. History proves otherwise. Initial liquidations remove the weakest positions, but stronger leveraged players often survive the first wave. These positions remain vulnerable. As prices chop or drift lower, pressure builds again. This leads to secondary liquidations, often smaller but more damaging due to reduced liquidity. These follow-up events are what grind markets down. They don't make headlines the way the first shock does, but they cause sustained declines. The danger lies in assuming the worst is over. Historically, the first liquidation reveals a problem, the next ones deepen it. Volatility becomes unpredictable and asymmetric. After a shock liquidation, volatility doesn't simply increase. It changes character. History shows that upside moves become weaker and shorter, while downside moves become faster and sharper. This asymmetry traps traders who expect balanced swings. Recoveries stall quickly, but drops accelerate with little warning. This environment punishes overconfidence and rewards caution. Traditional indicators struggle because market behavior shifts. Even artificial intelligence models trained on normal conditions can misread risk during these phases. The unpredictability isn't random, it's structural. Participants are no longer trading opportunities, they're managing fear. History consistently shows that asymmetric volatility favors capital preservation over aggressive positioning. Institutions quietly reduce exposure. When a $5 billion liquidation hits, institutions rarely announce their next move, but history shows they adjust quietly. Exposure is trimmed, not eliminated, and risk thresholds are tightened. This subtle withdrawal reduces market support without causing immediate panic. Prices don't collapse instantly, they weaken gradually. Retail traders often misinterpret this as consolidation. In reality, it's redistribution. Institutions protect capital first, returns second. This behavior has repeated across financial crises and crypto cycles alike. By the time public sentiment turns negative, much of the smart money has already repositioned. The danger for late participants is assuming institutions are still fully committed when, historically, they're already stepping back. Artificial intelligence flags. Stress others ignore. Artificial intelligence systems used by large players often detect stress long before it's visible. After major liquidations, these systems flag rising correlations, thinning liquidity, and behavioral shifts. History shows that when artificial intelligence signals align across institutions, risk reduction follows quickly. This doesn't cause crashes directly, but it accelerates caution. Human traders may dismiss volatility as temporary, but algorithmic systems respond without emotion. This widening gap creates imbalance. While some chase rebounds, automated systems quietly de-risk. Over time, this drains momentum. Artificial intelligence doesn't predict collapse, it reacts to instability. History shows that when these systems turn defensive, markets struggle to regain strength until conditions truly reset. Smaller players become the shock absorbers. History shows that after large liquidations, smaller investors absorb much of the remaining damage. They buy dips expecting relief rallies, providing temporary support. This creates false stability. When prices fail to follow through, these positions turn into future sell pressure. It's not exploitation, it's structure. Larger players wait for confirmation, while smaller players act on emotion. This pattern repeats across cycles. The result is drawn-out declines instead of clean reversals. What makes this phase dangerous is how calm it feels. Volatility lowers briefly, optimism returns, and then another leg down begins. History consistently shows that retail participation peaks after major liquidations, not before recoveries. Recovery narratives appear too early. After every major liquidation, confident recovery narratives flood the market. Analysts highlight past rebounds, influencers promote optimism, and selective data supports bullish cases. History shows this happens almost immediately, often too early. These narratives serve a psychological purpose, not a market one. They stabilize sentiment temporarily, but fail to address structural damage. When recoveries stall, disappointment sets in. This cycle drains momentum and increases selling pressure. The danger isn't optimism itself, it's premature certainty. Real recoveries show volume strength, broad participation, and time. History makes one thing clear. When hope moves faster than structure, markets usually move lower before they move higher. Price bounces don't mean risk has passed. One of the most misleading signals after a $5 billion liquidation is a sharp bounce. History shows these bounces are common and often violent. They create the illusion that the worst is over. In reality, they're fueled by short covering and opportunistic buying, not renewed confidence. These moves fade quickly once pressure returns. Traders who chase rebounds become trapped when momentum disappears. The real danger lies beneath the price action. Liquidity remains thin, leverage lingers, and sentiment is fragile. History shows that sustainable recoveries are slow and boring. Fast rebounds after major liquidations are usually warnings, not confirmations. Time becomes the greatest risk factor. After a massive liquidation, risk doesn't disappear. It stretches out over time. History shows that prolonged uncertainty erodes capital more effectively than sudden crashes. Chop, slow declines, and failed rallies exhaust participants emotionally and financially. Mistakes increase as patience wears thin. This is where accounts bleed rather than break. Time amplifies errors, especially for those overexposed. The longer instability persists, the harder recovery becomes. Experienced players respect this phase and reduce exposure, not because collapse is guaranteed, but because opportunity cost rises. History teaches that surviving prolonged uncertainty requires stepping back, not staying emotionally invested in every move. History's warning is about survival, not fear. When history says you should run, it doesn't mean panic. It means prioritize survival. After $5 billion liquidations, the goal shifts from profit to protection. Those who step aside preserve capital and clarity. Those who stay overexposed fight fatigue and emotion. History shows that the biggest winners aren't those who trade every storm, but those who wait for stability to return. This isn't about timing tops or bottoms. It's about avoiding environments where risk overwhelms reward. Running, in this context, means respecting history's lessons. Markets always offer new opportunities. Capital preserved today becomes flexibility tomorrow. A $5 billion liquidation isn't just a number, it's a signal history has sent many times before. The patterns are clear. Liquidity thins, confidence weakens, and risk stretches far beyond the first drop. This doesn't mean disaster is guaranteed, but it does mean caution is justified. Markets reward patience far more often than bravery during unstable phases. If this breakdown helped you see why experienced participants step back after moments like this, support the channel by liking, sharing, and subscribing. Leave a comment with your take. Awareness grows when knowledge is shared. Stay sharp, stay disciplined, and stay ready, because history always repeats for those who ignore it.